Most people believe that being wealthy means avoiding debt at all costs. This couldn't be further from the truth. The richest individuals on the planet have discovered a secret that transforms debt from a financial burden into a powerful wealth-building tool. When used strategically, borrowed money becomes the accelerant that turns modest investments into substantial fortunes. Understanding the leverage mindset, the average person works hard to eliminate debt. They pay off mortgages, eliminate credit card balances, and celebrate becoming debt-free. Meanwhile, billionaires are doing the complete opposite. They're borrowing more money, not less. The fundamental difference lies in how each group views debt. For most people, debt finances consumption, a new car, a vacation, or luxury goods that depreciate in value. This is bad debt, and it should be avoided. However, wealthy individuals use debt for an entirely different purpose. They borrow money to purchase income-generating assets or appreciating investments. This is good debt, and it's the cornerstone of generational. When someone borrows money against assets that appreciate or generate cash flow, something remarkable happens. The borrowed funds amplify their returns without requiring additional personal capital. If you invest $1 million and achieve a 10% return, you earn $100,000. But if you borrow $4 million at 8% interest to purchase $5 million worth of appreciating assets, you control a significantly larger investment while only risking your initial capital. This is financial leverage, and it's how the ultra-wealthy accelerate wealth accumulation. The buy, borrow, die approach, one of the most powerful strategies wealthy individuals employ, is often called the buy, borrow, die method. Elon Musk exemplifies this approach perfectly.
The case, then we need to do everything possible to ensure that
the world's richest person owns billions of dollars in Tesla stock. Rather than selling these shares to fund his lifestyle or other investments, Musk borrows against them. According to regulatory filings, approximately 1/3 of his Tesla holdings, roughly 238 million shares, serve as collateral for personal loans. This strategy offers multiple advantages. First, borrowed money doesn't trigger capital gains taxes, so he maintains his ownership stake and continues benefiting from future appreciation. Second, Tesla shares can be used to secure additional loans at favorable interest rates because lenders recognize the collateral's substantial value. The wealthy also leverage real estate in similar ways. Rather than paying cash for property, they take out mortgages and use the property's equity to secure additional loans. This allows them to control multiple properties with limited personal capital. When a property appreciates in value, the owner benefits from the full appreciation while having risked only their down payment. A property purchased for $1 million with only $200,000 down experiences the same appreciation as if purchased entirely in cash. The remaining $800,000 can be invested elsewhere, potentially generating additional returns. Another sophisticated method is the leveraged buyout strategy. Wealthy individuals and private equity firms identify undervalued companies with strong cash flows. They then borrow substantial amounts, sometimes 90% of the purchase price, to acquire these businesses. The borrowed money becomes company debt, not personal debt, which protects the buyer's personal assets from risk. The company's own revenue then services the debt while the buyer profits from operational improvements and eventual resale. This approach allows entrepreneurs to acquire multi-million-dollar businesses while risking relatively small amounts of personal capital. Tax advantages and liquidity management. Beyond amplifying returns, leveraging debt offers significant tax benefits that wealthy individuals exploit legally. When you borrow money, the interest you pay can be deducted from your taxable income in many scenarios, effectively lowering your overall tax liability. A business owner who borrows money to expand operations can deduct the interest payments, reducing their tax burden. An investor using a securities-based line of credit to purchase investment assets may deduct interest expenses up to the amount of investment income earned. The wealth transfer advantage is perhaps the most powerful. When wealthy individuals use the buy, borrow, die strategy, they can potentially avoid significant capital gains taxes when passing assets to heirs. At death, inherited assets receive a stepped-up basis, meaning the cost foundation resets to the fair market value at the date of death. If someone bought Tesla stock for $10 per share and it's worth $200 when they die, their heirs inherit it as if they purchased it at $200. All the unrealized gains between $10 and $200 escape taxation entirely. Combined with the buy-borrow strategy, this allows multi-generational wealth preservation with minimal tax consequences. Wealthy individuals also use debt strategically for liquidity management. Rather than selling appreciating assets and triggering capital gains taxes, they borrow against those assets. A business owner who sold a company stake for $2 million could use those proceeds to pay capital gains taxes of $400,000. Alternatively, they could borrow $400,000 against their investment portfolio, preserving the proceeds for additional investments while paying off the loan over time. The interest paid is a deductible business expense, potentially offsetting other income. Risk management and strategic implementation. While leverage can amplify wealth, it demands careful management. The risks are equally amplified. When borrowing against securities or property, asset values can decline, triggering margin calls that force rapid sales at unfavorable prices. If asset values fall below the loan's required collateral levels, lenders demand either additional collateral or loan repayment. Forced liquidations can create devastating losses, particularly in volatile markets. The wealthiest individuals manage these risks through diversification, conservative debt to equity ratios, and realistic interest rate coverage. They ensure that expected returns from borrowed money exceed borrowing costs with a sufficient margin of safety. They also diversify across multiple asset classes and geographic regions, reducing the impact of localized market downturns. For most people, extreme caution with leverage is advisable. However, moderate strategic borrowing for proven income-generating investments, such as rental properties or small businesses with strong fundamentals, can accelerate wealth building. A mortgage for a rental property where rent covers the monthly payment allows you to build equity while generating cash flow, essentially having someone else pay down your debt. The distinction between the wealthy and everyone else often comes down to debt philosophy. The wealthy view debt as a tool for controlling appreciating or income-generating assets. Everyone else views debt as something to eliminate. By understanding how leverage works, the advantages it provides, and the risks it carries, you gain insight into why the wealth gap continues widening. The rich aren't just earning more, they're multiplying their capital through strategic borrowing, tax efficiency, and patient long-term investing. That's the real secret to multiplying wealth through debt,